could happen because there were maybe other issues which the Supreme Court was handling, which was of higher importance. But this time they have formally admitted the case. Till now the admission itself was going up, down, formally admitted, and I think and now the hearing will start. But I don't think any decision looks to be, to be reached in near future. It may take a couple of years, but our positioning, our understanding, our assessment of the situation, we are fairly confident that this will be favorable for the company because whatever we did was in accordance with the law then. On PAG, you had any specific question?
No, just wanted to check if any change in position. I think in the past you said that as management there is something that you cannot change. But is there any change in the position?
Not really. I mean, as I've always maintained that there are financial sponsors and there will be a change of ownership at some point in time. But at this point in time, there is nothing that has changed in the recent past.
Okay. Thank you.
Thank you. We take the next question from the line of Prayesh Jain from Motilal Oswal Financial Services Limited. Please go ahead.
Hi, just a few questions. Firstly, on Nuvama Wealth, if I look at the MPIS revenues sequentially, they have been flat. You had incremental money coming in from these flows. They should have an equity mark-to-market positive. Yet the revenues on MPIS appears to be flattish sequentially. So what would you ascribe that to?
See, basically, composition of the MPIS also matters. Now, if you break MPIS into two buckets, Prayesh, there is managed products and there is investment solution. So managed product is your classic AIF, MF, PMS, and investment solution is your fixed income, MLD, insurance, and largely unlisted and syndication deals. So if in the investment solution bucket, there are certain categories which have different kinds of yields. So your overall flow may not directly correlate in terms of the revenue because just to give an example, I mean, if you do insurance, the earning is fairly different from what you get if you do fixed income versus MLD. So I think that composition creates a bit of a quarterly variance. But as long as your net new money is on the upward trend, and if you look at the trend of the numbers in MPIS, I don't think there is any structural concern. There is 11 quarters of growth. And if you look at a year-on-year growth, it's about 48% on 9-month basis and 22% on a Q-on-Q basis. It's just 3 crores down from previous quarter, which I don't think merits any concern from a trend perspective.
Right. Generally we've been used to seeing consistent growth, and that is the reason. Just pointing that out.
Yeah.
The other question was on your asset management piece, where you mentioned that there have been challenges to flows given the volatility in markets on the private equity side, on the listed equity side. But is there also a point where because the number of accredited investors is increasing and they are looking to get into smaller ticket size and probably more varied products, is that any cause of concern with respect to incremental flows from an industry perspective?
From the numbers, at least what we are seeing, that is not something which we have witnessed as of now. Not really, no. Theoretically, what you're saying can have a bearing, but I think it is not visible. In fact, not at all. None of our discussions internally has brought this topic up. In fact, in Nuvama Wealth, we were trying to position this to the clients that if they take accredited status, they can actually go ahead and do a large number of credit funds at a lower ticket, which will give them a much higher diversification. But then what we faced practically on the ground is that the fund managers have a number of investors cap of 1,000, I think. So they don't really want to encourage this significantly unless they have the ability of, launching multiple schemes. So we'll have to see how that evolves, this whole accredited investors thing.
Got that. And last question on the asset services front, where, we, in terms of revenues, we still are, from the peak of what we had, say, 1Q FY26 or even for that matter, 4Q FY25 when we had about 198 crores of revenues, we still had about 172 crores. You had kind of alluded to the fact that you'll be back to full revenue potential by fourth quarter. Are we on course to do that, or probably we're still running behind on that? And just an extension to that, you mentioned about adding more services here from a RTA perspective. Do you think that that will kind of add to cost in the initial period and then probably help you get better revenues and profitability over a medium term? Yeah, those would be my last questions.
So, when you look at the revenue in asset services, one component you earn from float, right? Now, float-related earning has two components, the float balance itself and the yield. So, from a float balance perspective, we will be back to full potential by end of Q1. But yields have compressed from Q4 and Q1 this year because of the rates going down. So, whatever residual impact in the difference in revenue which you will see will be because of the fall in yield. And I think in Q1, maybe once the float goes even further up, we will be able to negate the impact of the fall in yield. On the services front, I think large part of the costs are already incurred, and these are not very high OPEX, CAPEX. These are more licensed, like trustee services do not require a very high amount of expenditure, and a marginal increase in market share will be able to compensate. So I don't think there will be any sort of impact which we will see in the numbers which are worth discussing, that, which we need to highlight. At least as of now, we don't see that.
Great. Thank you so much, and wish you all the best.
Thanks.
Thank you. We take the next question from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hi, good morning, sir. So a few questions from my side. First, on Nuvama Private and Nuvama Wealth, if you can give us some color on the gross net new money in recurring assets versus the redemptions, so that, across, let's say, the third quarter or maybe 9 months, so that we can get some color on how the gross money into the ecosystem has been shaping up. The second question is, in terms of the cost, variable cost reduction that we have seen, how comfortable are you on fourth quarter? I mean, you give some, Bharat gave some color on the fourth quarter, but do you have any more headroom in case, let's say, the revenues were to kind of dip a bit in 4Q also? And third question is on the IBI business. If you can split up the margin profile of the business between DCM, ECM, and your IE. And just for clarification, I think at the start of the call you gave some color on the flow expectations in AMC in FY27. Did I hear it correctly that you're expecting around 7,000 to 9,000 crore of flows in that?
So let me go one by one. In your gross ARR assets for private, I think would be order of magnitude about 4,000, 4,500 crores for the quarter. And net we saw was about 1,500, 1,800. So balance would be the adjustment in terms of redemption or scheduled maturities and all that. We don't track ARR, non-ARR in wealth, so that maybe we will check, and when we talk next we can give that number. On variable cost, essentially in this quarter the adjustment was largely around two businesses. One, was in Nuvama Private, because in Q2 we saw the revenues go up, so therefore in line with that the incentive and the bonus provisions went up, and second was in the capital markets business. So in both we have the flexibility to move up and down, and broadly we try to track the variable provisions in line with the revenue so that we don't have a shock in any quarter. In fourth quarter, it's not that we will have something unreasonable or large come in, which is disproportionate to the revenue percentage. So it should be in line with what we have been seeing till now, and our overall cost income range also should be in line. It will not be materially different. In terms of the margin profile for ECM, DCM, we've not gone to that level because there are a lot of resources which are also common. But broadly, if one were to, I mean, this is just a guess. I don't have actual numbers. DCM would be maybe slightly better margin because people cost could be slightly lower than ECM side. Maybe one is at 40, one is at 60, and blended we operate at 50. And institutional equity will range from a 50 to 60, 65 range depending on the performance of revenues. When the revenues go significantly up, the cost income comes down, and vice versa. On AMC, yes, you heard right. I can tell you broadly how we are looking at the breakup. Essentially, if you are able to launch our new commercial real estate fund and do maybe 2,500-3,000 there, and if credit is also launched, which we are planning maybe by Q1, latest by Q2, and one could do another 2,000-3,000 there. Once we migrate our flagship strategies of current AIF, absolute return, and long short into SIF, we expect flows to improve because SIF gives us significantly improved tax profile for the customers, and our absolute return and long short still are in the top quartile in terms of performance. So I think that will start attracting flows, and it also opens up a large set of distributors. Maybe we will take time to onboard them because we are not a retail brand, but it opens up the 10 lakh distribution IFA community as and when they qualify to distribute the same. So I think combination of these three could essentially give us another 2,500. So that's, if we add all this up, order of magnitude anywhere between 6,500, 7,000 to 8,000, 9,000. Without taking into private equity, I think that will be an added upside element. That's how the numbers add up.
Thanks. I think just one follow-up on the gross flow side, if you can give the same numbers for 9 months. Thank you and all the best.
About 15,000 crores. 13,000 crores. 13,000 crores.
Thank you. Thank you and all the best.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Mohit Mangal from Centrum Broking Limited. Please go ahead.
Yeah, thanks for the opportunity. My first question is towards the net flows. So I think, if I look at this quarter, so Nuvama Private, has seen a considerable uptake led by the transactional segment, while Wealth has seen a kind of a decline from around 3,800 to 3,250 odd crores. Now, going to financial year 27, how do you see net flows actually spanning out? That would be my first question.
So, net flows become important in two things. One, for private, we should look at the ARR net flows. ARR net flows this year for private right now is about 9 months basis, about 6,500 crores. And order of magnitude, it should end up at around anywhere between 23 to 25% of the opening. Let's say we are right now sitting at about 52,000 crores of assets in ARR. If we end the year at, say, 54, 55, and you take a range of, say, 20 to 25% of that, you are looking at 10 to 11,000 crores or maybe 12,000 crores next year in Nuvama Private. And if you come to sort of Nuvama Wealth, I think similar, about 25 to 30% of the opening book which we will have in the MPIS segment. So that's how essentially one should track the net flow numbers.
So this is helpful. My second question is on the cost to income. So I think you've guided for 10 to 12% increase in OPEX. So does that also cover the RM addition that we are doing? Because
No. So when we speak our lingo, OPEX means everything else other than people cost. People cost is different. So people cost, I think if I look at a 9-month console, we would have grown by about 7% year on year, and by the end of the year maybe it can be slightly higher, but order of magnitude this only. OPEX is everything else other than people cost. So there, last year we were about 410 crores. I think this year we should end up anywhere between 440 to 445 crores. So that's the 10% increase is what we talk about.
Okay, understood. This is very clear. And just lastly on basically the RM addition, I think we are adding about 10% to our RM strength. So I think this strategy will continue, right? Over the next 2 to 3 years.
Yes, absolutely. Yes. This continues.
Right. Thanks and wish you all the best.
Thank you.
Thank you. We take the next question from the line of Nidesh from Investec. Please go ahead.
So thanks for the opportunity. First question is on private wealth. So there is an increase in yield in this quarter. What has led to that increase? And secondly, what is the run rate of transactional revenue that we should build in this business?
So yield increase typically happens because of the composition of the products in the ARR basket. Sometimes if the salience of category 2 will increase slightly, because there you earn about 30% in year 1. So that gives a bump up. But on a BAU basis, I think any range between 80 to 85, 90 bips is what we will continue to see there. In transactional income, broadly this year we should see about 20% growth. So like last quarter we saw about 110 crores of revenue. This quarter we saw 64, 65. I think anywhere between 70, 80 crores is a decent run rate till going forward is what we are going to see.
Second question is on wealth management.
Yeah, go on.
Yes, so on wealth management, can you give some color on MPIS income? How much of the revenue is upfronted? How much is, let's say, trail-based, etc.?
The overall wealth management, around 60% comes from MPIS and about, say, 20% comes from NII, and balance is your broking and others. And if I look at full wealth management as a bucket, around 55% comes from ARR. So if I subtract 20 of NII from there, around 30-35% will come from recurring revenues within the MPIS bucket. So 60 divided by 2, let's say about 30 to 35% of that 60 breakup. So 20-25% would be upfront and 30-35% would be recurring.
Understood. And last question is on asset management. In that segment, the yields are quite volatile among segments with private markets, public markets, and real estate. So how should we model that? So what is leading to this volatility in yields, and how should we model it?
Actually, it's a temporary thing. In real estate, what happens is that every time till the time you close the fund, right? Right now we have reached about 3,000 crores. As I said, another 1,000 crores we will hit the end of the fund, and after that the yield will stabilize. Because every time till the closure, when a new investor comes, at that point in time, in that quarter, you charge fees from the beginning. So in any quarter, if let's say we move from 3,000 to 4,000 in one quarter, on that 1,000 crores in that quarter, from the beginning till end of quarter 4, the full fees will be charged. So once we hit 4,000 on commercial real estate, the fees will stabilize, which will be order of magnitude 50-55 basis points. On private equity, you can assume it to be around 50-55 basis points. And on public markets, the fees have been fairly steady at around 60-62 basis points.
Sure. So there will be an element of carry also, right, in these businesses?
No, right now
will get
zero. This is zero
right.
carry. As of now, we don't take carry into consideration. We take carry as and when it comes. If we change that policy in the future, we will tell you.
Sure, sir. Thank you, sir. Thank you. That's it from my side.
Thank you. We take the next question from the line of Shrenik Mehta from Indo-Alps Wealth. Please go ahead.
Hi. I just wanted to ask you a question about this institutional equity segment. We have been seeing significant declines over the last few quarters. What parameter would you use to say that there is potentially a bounce back, whether this is the number of active institutional clients or is it the overall cash volumes that will help us say that, we will start getting back to a year-on-year growth?
I think two things. One is the cash volume and second is the derivative volume. These are the two components that essentially once they start moving up and if the market share remains intact, which typically for us remains intact, then you start seeing growth coming back.
Okay, and are you seeing any early signs of it?
Yes, at least in this quarter, we have seen quarter on quarter there is an improvement in the average daily turnover. Because on a year-on-year basis, Q4 will become full, I think, clean quarter where the FNO rules, if you remember, came middle of Q3 last year. So half of Q3 had higher numbers in FNO volumes, and then it sort of subdued. And Q4 onwards, you get a base which is with the new FNO rules. So this Q4 will be the first quarter with. So I think you should see a year-on-year uptick start happening because the base effect will come into action.
Okay. Thank you.
Thank you. We take the next question from the line of Lalit Mohan Dev from Equarius Securities. Please go ahead.
Yeah, hi, sir. Good morning. So there's two questions. So firstly, on the lending book, we highlighted that we are seeing some strong growth in the wealth business where we have scaled it up to 4,300 crores. So now how should we say this for the next year? And similarly in the private also, like where we are at around close to around 2,500 crores. So how should we see the overall loan book?
Ideally, we'll have to grow it in line with the business. So anywhere between 20 to 30% is what we will target for next year.
Sure, sure. And so just like we have also highlighted, we also touched upon this advisory piece in the Nuvama Private, which is the Infinity. So like, so current, what is like the overall current AUM over there, and like how should we see this in respect to the distribution business in the ultra HNI segment?
I think right now we are not separately disclosing. It's a part of the ARR AUM. We are also discussing internally on whether to call it out separately. So give us a couple of quarters and maybe we can give you the numbers, but it's growing significantly within the ARR AUM.
Sure, sir. Yeah. Thank you, sir.
Thank you. We take the next question from the line of Sanket Gowda from Avendus Spark. Please go ahead.
Yeah, thank you for the opportunity. Ashish, probably the question on asset services still remains to me because I mean, if I look at Q3FY25, your yield or retention was 1.4%. Now it is more than double of that, 2.88. So just to understand, this model really works on retention, or is it you calculate a growth number, how much you want to achieve from the clients, and then accordingly you rebalance the cash and GSEC component so that incrementally revenue doesn't fall. Whether building a model around the yield is actually right, or how do we understand this way to look at this business?
So, I think what you're saying is quite pertinent. Actually, last year in Q1, we had the large client, right? Now, the large client was disproportionately large as compared to others, so therefore there was an adjustment. And actually, the answer to both your approaches is a yes. That is the challenge, that if somebody becomes very large, then the correlation with yield will fall off, because then you will target a growth and adjust the cash and non-cash securities. But if they are all within a particular range, then I think the yield works, which is the case right now. So I don't see this breaking suddenly in the near future, and should be in the range of 2.6 to 2.9% in terms of the yield on the clearing balance. Now, why it was 1.4 and becomes 2.9 is how that clearing balance is split between cash and GSEC, which what you said was absolutely right, that if somebody becomes very big and they want to reduce the cash, then we will have to target a growth and therefore adjust accordingly. But I don't think for the next 12 to 24 months we have to model for that. We don't see any client going to that size.
So incrementally 2.6 to 2.8 kind of a number is a realistic number to build in.
Yes, that's right.
Understood. And maybe for the first time, asset clearing revenue AUM grew. So which means whatever migration need to happen from insti to wealth, or even the fall which will happen from the large client. Now we assume this growth to come back, kind of a thing in the assets under clearing. Correct.
That's right.
Okay. And lastly, just want to check this is SEBI came out with a paper that on FIIs there is netting is allowed.
That's only for cash market, not for derivatives. Anyways, derivatives margin-based business, so doesn't matter.
But in this revenue, we don't make any significant from the cash in asset clearing from FIIs.
No. Cash-related float is insignificant.
Okay, understood. And lastly, Ashish, is on the flow number. I know I asked this question typically that you gave a guidance of around 20,000 crores for the year, closer to 20,000 crores, and now we are at 14,000 crores. So we need to get closer to 5,800 to 6,000 crores for the fourth quarter to achieve that number, and you are seeing a growth of 20 to 30% on that number for the next year. So just wanted to understand, given the two core pieces, that is private and wealth, saw a sequential decline QOQ, means your confidence on delivering 20K kind of a number. Is there any macro factor, because market sentiments have weakened meaningfully in last maybe 2 weeks, maybe 3-4 weeks, or 1.5 months? Then your RMs interacting with the clients, how do you see whether the money will come or they are waiting and watching? Something, any color on those will be very useful to understand.
So largely around the product calendar or the products which you have, which are non-correlated to equity markets, is what gives us the confidence to be, in line with that number. Because equity flows are equity flows. They will always keep moving, at least in the higher net worth segment and ultra high net worth segment. They are not as, I would say,